Hey everyone, and welcome to the DeFi Drop. Today's episode features Ermin, co-founder at Aegis. Aegis launches institutional-grade stablecoins offering risk-adjusted yields through delta-neutral strategies, executed through institutional custody, off-exchange settlement, and real-time reserve transparency. Welcome, and thanks for joining us, Ermin.
Thanks for having me on the show, Edward. We are building institutional grade stablecoins, and what we want to do is to provide yield-bearing products for crypto market as well as for TradFi institutions and TradFi users that want to get slightly higher return compared to TradFi returns in crypto.
All right, cool. So actually, let's start with the bigger picture then. Okay. Aegis is, like you've said, you're building institutional grade stablecoins that generate real yield. For anyone new to Aegis, what's the core problem you're actually solving, and how are your products different from the traditional stablecoins?
Yeah, that's a great question. I think I'll start with the story of Aegis, how we actually came up with the whole idea of why of the Aegis and the company. So it was 2023 when the Silicon Valley Bank collapsed, and there was a major distress within crypto, especially on the stablecoin side. So a good example is the DPAG of USDC that hold part of their collateral and reserves in Silicon Valley Bank. So the DPAG of USDC showed two problems, I think. The first one is that, when you put too much trust in one product or in one company, it can surprise you that this company cannot do well in a certain market conditions. So I think before this DPAC, everyone thought that USDC is the most reliable, the most stable coin, because they have all of the audits from top tier auditing firms. They have all of the reserves in US based big banks, but even that didn't protect them from DPAC and from potential loss of the collateral and reserves. And the second thing is, that fiat-backed stable coins are exposed to this risk of the fiat banking system. So that's why we came up with the idea of Aegis. First of all, we wanted to solve two problems. We wanted to come up with a crypto native stablecoin that would exist within the crypto ecosystem and use crypto tools instead of relying on the fiat banking world. And the second problem is that we wanted to deliver a yield-bearing product so that you don't just have a stable price asset like a stable coin, but you also have some, passive yield accruing on top of your holdings. The same way you have it in traditional banks, right? When you make a deposit, and you keep funds for a certain period of time, you get some yield on top of your deposit, which basically is generated from the lending activity of the bank. So yeah, those are two problems that we wanted to solve, and we came up with a solution. So our first product is YUSD, which is a yield-bearing delta-neutral stable coin backed by BTC. Essentially, what we do is we create a synthetic financial position within crypto that that allows us to be delta neutral and price stable, so we can build actually the stable coin out of that. And the second thing, it allows us to generate yield and basically provide this yield to the end user. And the way we do that is we take the collateral. So users comes to us and they deposit USDT, USDC, or DAI. Then we take this collateral, we transfer it to the custodian. So all of the assets are kept within secure institution, like let's call it like a crypto bank, although they do not rely on the fiat rails. So it just, a segregated accounts where you hold a crypto in the cold storage, so it's not exposed to potential hacks and it's really hard for a custodian to lose money. So yeah, that's where the money, the collateral is kept. Then we open the positions on the exchanges through ClearLoop, which is also technology that is provided by one of the custodies that we use. The custody is called Copper. So we open the positions of the exchange. We go along spot BTC. So we buy Bitcoin on the spot, and we go short BTC margin perpetual futures. So essentially, what it creates the delta neutral position. So for example, we buy one Bitcoin on the spot, and we short one Bitcoin through this instrument, through these perpetuals. Essentially, the value of the position is delta neutral. So the position is delta neutral. So we're not exposed to the movements of Bitcoin. So we don't care like Bitcoin goes up or down. We are always 1-to-1 hedged. That's how we create stablecoin, and also we earn funding rate on our short position. So there's an instrumental feature in this perpetual futures that is called funding rate that allows to to stabilize the market between longs and shorts and to incentivize one part of the market. So we earn that and we distribute it to the holders of our stablecoin. So yeah, we actually solve two problems. The first one is the price stability, so we create a stable coin, and the second one is yield. So we generate yield, we distribute it to the holders, and everything happens in a very seamless way. So we don't need to perform any additional actions. We actually one of the features that we have, you don't need to stake in order to receive yield. So you just hold that asset, you claim the yield, and that's it. So it's a Web2 experience in crypto. And yeah, that's our core product. We have some other products lined up to be launched next year, early next year, that are also stablecoin based with yield. But yeah, we can talk about it a little bit later.
Perfect. We'll save those products for just a bit. You've walked us through the delta neutral strategy, which is really useful. Thank you. We now know what it means, okay, and how it generates yield. That was really clear. I think what might be useful as well is just to understand, I know you've spoken a bit about it, but a bit more about what happens when funding rates go negative in a bear market, all right, with your delta neutral strategy. Just maybe a little bit more technicality on that.
Yeah, sure. So I mentioned funding rates and this feature that kind of like balances the market between longs and shorts. And if you look historically, 87% of the time, funding rates are positive. That means that longs are paying shorts. And since we are on the short side on this instrument, on perpetuals, we are earning 87% of the time. So those 13% of the time, the funding rates goes into negative territory, which means that we are losing money. But in order to protect the users, we have the insurance fund that is basically growing each time that. So when we receive the funding rate, it's basically the revenue of the protocol, right? Well, we distribute 90% of that to the users, and 10% we take as a protocol fee, or you can call it like a performance fee, that we put into the insurance fund. So we actually don't use it for anything related to to the company. We put it into the insurance fund to bring more stability to the protocol. So when the funding rates go negative, we need to resupply the margin on the exchange and basically take to resupply the margin, we take it from the insurance fund. And yeah, that's how we kind of like mitigate the effect of the negative funding rates. And the most important thing I think here is that, first of all, the risks of negative funding rate are super low because it's only 13% of the time when the funding rate goes negative. And the second thing, that we do not transfer collateral to the exchanges itself. It's always within the copper and clear loop. So it's within the custody. We actually trade for off-exchange settlement. That's the thing that I forgot to mention. So we do off-exchange settlement. That means we never move the collateral to the exchanges. It adds additional level of security and protection for the collateral for our users. And that's super important.
Yeah, okay. So we've slightly moved into the security and transparency side here, and obviously you've mentioned that just now and previously the institutional custodians that you use, Fireblocks, Copper as well. You've just touched on off-exchange settlement again and real-time proof of reserves. Let's carry on a bit about the risk, I guess. Walk us through how that architecture actually reduces risk, like compared to keeping funds on exchanges.
Yeah, sure. So one of the things that we were, really, putting a lot of thought into is how to protect capital and collateral in order to deliver, a super secure product in the market. Because if you look at the stablecoin yield generating stablecoin space in general, there is a chase for higher yields. And when you try to chase for higher yields, that means that you need to take much more risks. And obviously in crypto, historically, users do not care about risks that much. And that's why when they see a higher APY or higher yields, they go into the product without checking, like, is my collateral secure? What the strategy the company deploys or a stablecoin issuer deploys, how they are managing risks, what the architecture is, how well protected they are from attacks, from hacks, and so on. So what we were putting a lot of thought into this, and we knew that it will be also a limitation for us, since you're delivering a super secure, super low risk strategy and super secure architecture. That means that your yield will be lower maybe compared to the market, but we did it intentionally so that we prove to everybody that there is still demand for risk averse assets and products in crypto. So the way we built it is essentially through these custodians. So we use Copper and Fireblocks, and we use off-exchange settlement in order to open the positions. Since at the core, at the backbone of our product is the trading strategies. So, the first one is basically basis trade. This delta neutral thing that I explained earlier. So by using Copper and Fireblocks, we are protecting collateral from the exchange risk. So we never move the collateral to the exchange. We open the positions on the exchange. We trade on the exchange, but through off-exchange settlement. And what this means, that there is a tri-party agreement between custodian, the client, which we are the client of the custodian, and also the exchange. And exchange allows us to mirror our funds that we keep on the custodian on the exchange, and use it as a collateral, as margin, and trade on open positions on the exchange without the actual movement of the assets from custodian to the exchange. So it's a great kind of breakthrough for crypto. And a couple of years ago, when, for example, FTX was live and so on, I never thought about this technology as a viable solution. No, nobody was interested in this solution. But obviously, after some hacks on the exchanges, after some failures of the exchanges, everybody started thinking about this, and everybody now uses off-exchange settlement. If we are talking about some serious crypto companies, even like fund managers, DeFi funds, they all use some sort of a solution that allows you to keep the collateral safe and don't take additional risks of the counterparty. So yeah, that's what we do. And that's how we trade.
So you have your SYUSD for passive yield. You've got your YUSD as trading margin, okay, on the Aegis DEX, which is your own trading venue. So these products obviously work together. How does owning both the stablecoins and the DEX create this competitive advantage?
You mentioned Aegis DEX. Yeah, it's a different product. It's the part of the ecosystem of YUSD, but essentially for trading, we use USDC, USDT, DAI as a collateral that we convert into Bitcoin. So we buy Bitcoin, we hedge it 1-to-1, and that's what backs YUSD. So it's essentially like BTC backed, but delta neutral via delta neutral strategy. Aegis DEX is basically the product that we launched in collaboration with Orderly Network, one of our core, strategic partners, and it allows you to utilize YUSD as a collateral on the exchange. So it's a bit different thing. It's end user product. It's basically not the architecture that we have inside Aegis in order to issue YUSD and so on, but it allows you to have additional utility of YUSD, because if you buy YUSD right now, you can earn yield. That's the simplest use case. But if you, for example, want to trade with it, you can go into Aegis DEX, which is our DEX that we built. You can put YUSD as a collateral there and trade different assets using this, using our stablecoin as a collateral. And also you can earn yield on top of this collateral. So essentially you're paying fees and you are earning on your collateral. So that's essentially like covering your trading fees, and it's a great use case, I think, for the crypto in general. So because as of now, you need to deposit to the exchange like USDC or USDT, trade with it. You are not earning anything on that. You're paying fees, and if you manage to trade with a positive PNL, that means that you are still losing on the trading fees. With us, like with Aegis DEX and YUSD, you're essentially offsetting those trading fees, and you are trading almost for free. So yeah.
Yeah. So how does Aegis's arbitrage mechanism then keep the YUSD pegged to $1, even during volatile market conditions?
So that is again due to the delta neutrality of the positions, like the backing mechanism. So when we open the spot position, like when for example you come to Aegis and you want to mint one YUSD, you need to supply $1 of like USDT or USDC or one DAI. Then we take that and we buy Bitcoin with that for $1. And then we open a short position with BTC margin perpetual shorts for $1. In that way, your position like always the same value, and it's always 1-to-1. So that's how we maintain the delta neutrality. As long as you are delta neutral, your assets are like fully deployed into Bitcoin and they're fully hedged. You're not exposed to the movements of the Bitcoin, so you don't have directional exposure. That's how we maintain the peg 1-to-1 to US dollar, because the value of the position is always the same, no matter what. Like Bitcoin goes up 2x, we like have the price appreciation on the spot side, but on the short side we are losing the same amount because short is in loss. So yeah.
Thanks. Yeah, you mentioned the one-to-one backing earlier, so I just wanted to reassure listeners how that system actually works and how you peg it. On that risky subject, we're always going to be in a financial crisis. Or there will always be a financial crisis, right? Whether or not we're always in one, because that's kind of how it's felt for the last few years. Always an aspect of the financial industry that's in crisis anyway. But your mission also addresses these big macro issues like inflation, right? Lack of access of banking and currency volatility. How does Aegis fit into this larger narrative of like modern money problems?
Yeah, when we were building Aegis, we actually had this thought in mind. What we are delivering is yield on dollars, right? And I think for most of the countries where local currencies are failing and losing value every day, we are kind of like the perfect solution for the people in those countries. If you look like, for example, in Turkey, Argentina, Nigeria, so all of these countries have very um, have local currencies falling off the cliff compared to like US dollar. So majority of the deposits in banks and so on, users try to convert into dollar. So once they convert into dollar, they don't have yield opportunities. So essentially what they can do, they cannot spend it, right? Because they need to convert back into the local currency. But for, savings, they just keep it, keep it in US dollars, and they don't earn anything additional on top of that. So with us, they can keep their savings in dollar and also protect themselves from inflation because from the US dollar inflation because you are earning additional yield on top of your dollar savings. So it's a perfect product for users in these countries where the local currencies are not that strong. And yeah, I think that's what we are trying to deliver to make everybody be their own bank. So you essentially have control over your assets. So we are not trusting any bank or any institution. And the second thing is that you are earning yield on top of your savings in the US dollar terms, not
Mm.
like in your local currency terms, but essentially in US dollar terms. So yeah, that's I think the perfect product for those markets. But
Well,
obviously, we also target the markets where the local currencies are pretty much stable. You still can earn additional yield that is superior to what you can find in TradFi. For example, if you buy treasuries, U.S. treasuries, you are earning, especially with the Fed cutting rates, you are earning like 3.5%, even less than that. So with us, you can earn 6.5% as of now. So
that's
obviously this yield can go up. It can go down, but it can go up as well. So yeah, but if you look on average, it's 6.5% as of now.
That's fantastic. Well, you raise a pretty interesting point as well, which it's not, I wouldn't say it was just currencies of certain countries that are losing value. We're starting to see this actually in the pretty much the broader global financial space, right? So a lot of big funds right now. I've been speaking to a few over the last few weeks and months. They're stockpiling their BTC and ETH holdings, and in preparation for what could be a huge period of devaluation for fiat currency in general. So I think, having listened to this pretty amazing, amazing rundown of Aegis, by the way, but I can totally see how you're setting yourselves up for future-proofing your stack and your value proposition for what could be a pinnacle 4 or 5 years in finance.
Yeah. I think that's the goal. So we want to be one of the main yield bearing products out there. Yeah, I would say we're not only a savings instrument. So obviously the core use case is a savings instrument. Basically the product that you can use to hedge your, exposure and limit the risks of inflation or instability in the fiat markets. But also we are building the ecosystem that, where you can use this stable coin and have actual utility on top of it. Not only savings, but you can also in the future we will be integrating with major payments providers, so with crypto cards, with different like lending markets, yield markets. So essentially, you'll have different source of utility for our stablecoin, not only just savings. because savings, yeah, the major use case, but there are a lot of other things that you can do with a stable coin. And yeah, our goal is to get integrated in as many places as we can, because I think stablecoin issuers, they should not limit themselves to only like one particular integration or one particular kind of like use case. Stablecoin, as well as the fiat currencies, they should be, accessible everywhere within different markets, within different products, and yeah. But again, if you look at the fiat currencies, the main use case is obviously payments, like exchange of value. So that's what we have in mind as well. But we are starting with this particular problem of savings in crypto, in TradFi, and we are delivering this first product. But in the future, we want to expand within like next 5 years into other use cases as well by delivering super safe product. Because I think most of the what most of the projects building yield-bearing stable coins right now are missing is that you need to provide super transparent and safe instrument, because any fiat currency, if you look at the example of fiat currencies, they are backed by central banks of countries, and they also backed by let's say taxpayers. In crypto, you have different sorts of backing. Like for example, we are backed by synthetic Bitcoin denominated position. There are other stablecoins that are backed like, I don't know, by OTC delta neutral stuff, by GPU loans, by there are different source of backing, but what we need to focus in an industry as a whole is bringing more transparency and more proof that your strategy is super safe and that you can protect the collateral, because that's the most important thing. If you cannot prove that you are protecting capital at any time, at any market condition, then there will be no trust in your stablecoin. Thus, nobody can use it as a means of like payment and exchange of
Absolutely.
the
Yeah.
value.
And confidence is everything, right?
Yes.
it's the underlying factor of a strong asset, right? It's confidence. So yeah, you're building that. Look, it's been so great chatting to you. I've really enjoyed it, and I can't wait for everyone to watch this and listen to this. But what's next for Aegis? Can you let us know if you've got any upcoming features, network expansions, partnerships, or anything that builders and traders should watch out for?
Yeah, sure. I think the major kind of like update for Aegis is that we are launching a new stablecoin. So our goal is to expand the product line so that we can accommodate to different risk profiles of the users. So the first stablecoin is super safe, transparent, low yield, low risk product for institutions, TradFi, and users in crypto that want to protect their capital. The second one is also puts the protection of the capital in the first place, but this new product will have higher APY due to the strategy that is also crypto native, and due to some crypto mechanics, it delivers a little bit higher APY. We'll reveal it in early January to the public, so I won't share like too many details right now, but again, it will expand, allow us to expand into a different market niche and to accommodate for the needs of the users that we are constantly talking to. So people want to have higher APY, but with the same, let's say, protection of the capital, with the same infrastructure that we'll have already built. That's why we're launching the new stable coin. Everybody asks me why you need a new stable coin when you just change the strategy for the main one. And the answer for that is that we want to protect capital again, and we want to segregate the risks of different strategies that we are deploying into different pools, so that there is no intersection between the investors and liquidity providers and users in the first product and in the new product. So the new product, so the people when they come to Aegis in order to save this issue with getting yield on top of their savings in crypto, they can choose like what strategy they are comfortable with, what risk profile they are comfortable with, and what APY they want to achieve. So yeah, that's kind of like what's coming for Aegis. We are diversifying our institutional grade stablecoin offering, and there will be more opportunities for users to achieve APY.
Fantastic. Thank you. And of course, we'll share your website and all socials as well after this. Aegis.im is your platform, so people can head over there.
Correct.
Ermin, it's really been great. I've really loved it. You guys are building something super clear with real use case in this modern day time. So we're going to end with our standard question that every guest receives. It's a bit of a game. You have no choice. You have to answer it. Okay, so
Okay.
the total TVL of DeFi, as per DeFi Llama, today is $116 billion. What's your prediction for this number at midnight on the 31st of December 2025? So that's only in 2 weeks' time. And I'm going to also ask you to give your prediction for this number in a year's time at midnight on the 31st of December 2026.
That's a pretty tricky question. Given the current market, I'd say for the 31st of December of this year, it will be less than that. I'd say, can I give a range, or I need to give like a particular
One number.
Closest
One
number.
Yeah.
Okay. I'll guess it will be 118. So a little slightly higher than the current one. But in the 1 year's time, I believe it will be around 300.
Excellent. So almost double ATH of DeFi.
Correct, and driven mostly by the stablecoins. So I'm pretty sure that the next year will also be the year of the stablecoins, because this year was the year of the stablecoins, and the major growth in DeFi and most of the protocols and blockchains, it was driven purely by stablecoin adoption. So, and I think next year will be also the year of the stablecoins, and this TVL in DeFi will be driven by stablecoins. So.
Excellent. Thanks for your insights. All right, Ermin, look, it's been great. I hope to catch up with you soon. Also, we are really pleased to be working with Aegis at Portals, with the widget and everything that's gone live. So yeah, we hope to continue this great partnership. Thank you.
Yeah, thank you for having me, Albert. And yeah, about Portals.fi, we are also super excited to be working with you, and I hope this new widgets on Aegis, users will be able to see them pretty soon. So yeah, stay tuned.
Cool. Well, thanks, Ermin. See you soon.
Yeah, see you. Thank you.